In recent months, the once unstoppable US dollar has lost significant ground. Headlines talk of a crashing dollar, but what's really happening? For the first time in years, US stocks, treasuries, and the dollar have all fallen together, an unusual trifecta that signals a shift in global confidence. In fact, JP Morgan analysts observe that the dollar's long-standing overvaluation is beginning to unwind and could fall another 10 to 20% against peers over the coming months. This rare, synchronized sell-off suggests major market investors are reassessing U.S. assets. The question is, which economic forces are driving this change? As we break down the factors, keep in mind a simple analogy. Imagine the U.S. dollar as a powerful magnet drawing global investment. For years, that magnet was getting stronger. Higher U.S. growth, strong equity markets, and rising bond yields kept the dollar on top. But now the pull is weakening. Several key shifts, from central bank policies to trade imbalances to investor sentiment, are easing that magnetic grip. In the following scenes, we'll explore each in turn. One of the most important drivers of the dollar is interest rate differentials. When U.S. interest rates rise above those of other countries, foreign investors flock here for higher returns, boosting the dollar. For example, the Federal Reserve's aggressive rate hikes of the past 2 years pushed U.S. rates to around 5.5%, well above many peers. That hawkish Fed kept dollar demand high. Capital chasing higher yields acted like a magnet on the currency. However, inflation in the U.S. has now fallen sharply, around 3% from peaks near 9% last year, easing pressure on prices. With inflation cooling, the Fed has largely finished its rate hikes. As RBC notes, once the Fed stops raising rates, the positive impact of higher yields on the dollar has largely played out. In other words, the faucet of U.S. rate-driven demand is starting to turn off. Imagine interest rates as a water tap filling a bucket labeled demand for dollars. As long as Fed rates climb, the tap poured fast. Now the tap slows and eventually stops, and without fresh inflows, the dollar's level begins to fall. Adding to this, global monetary conditions are shifting. Other major central banks, Europe and Japan, are facing less disinflation and may hold rates higher longer than earlier expected. This narrows the gap with U.S. yields. One analysis shows the gap between U.S. 10-year yields and those of other rich economies is near its widest in decades. But if U.S. growth slows or the Fed cuts faster than elsewhere, that gap will shrink, meaning less foreign capital chasing the dollar. AllianceBernstein points out that a weaker dollar would tend to push U.S. inflation up a bit and raise Treasury yields if overseas holders sell bonds, further feeding back into lower dollar demand. In short, the Fed's policy stance has been a double-edged sword. It's strengthened the dollar via high yields, but now that inflation is down, a pivot by the Fed would likely weaken the greenback. Beyond rates, the U.S. runs persistently large twin deficits, both fiscal and trade, which tend to exert downward pressure on the dollar. Intuitively, running a big trade deficit, importing more than exporting, means sending more dollars abroad. In currency terms, it's like pouring excess water out of our bucket. More supply of dollars overseas pushes its value down. Indeed, analysts often cite America's growing twin deficits in government budget and current account as a key factor. RBC Global reports that many valuation models see the dollar as about 20% rich or overvalued relative to fair value, in part because the U.S. keeps running large deficits. Put differently, the fundamentals suggest the dollar is due for a correction. JP Morgan Asset Management similarly warns that the U.S. trade deficit, about 4.2% of GDP as of late 2024, is a structural constraint on the dollar. A country that continually spends more on foreign goods must finance that gap by issuing debt or attracting investment. And if confidence wavers, that financing becomes harder. One simple analogy: think of the U.S. government and consumers drawing money from abroad to pay for imports and spending. That's like continually removing money from our dollar bucket without adding enough back. So the price has to adjust downward until balance is restored. Some also note that recent U.S. policy effectively weaponized the dollar through sanctions and trade wars, prompting others to diversify. For decades, the U.S. financed its deficits by offering its currency. Global investors and central banks eagerly held dollars because of the stability. Now that dollar dominance is being questioned, there is talk of de-dollarization. Some countries and investors hold a bit more euros, yuan, yen, or even gold to hedge against dollar volatility. This shifting demand mix erodes the dollar's support over time. In fact, an IMF analysis confirms that central banks have gradually reduced the dollar share of global reserves in favor of a wider basket, including Canadian and Australian dollars, renminbi, and others. While these moves are slow, they signal that a once super strong dollar no longer has the same unchallenged status. So far, we've covered rates and deficits. Another critical factor is investor sentiment, especially U.S. policy uncertainty. Foreign confidence in the dollar depends on trust in U.S. leadership, its political stability, and the rule of law. Historically, analysts emphasize that the dollar's reserve currency role was built on predictable, rules-based policy, an independent Fed, transparent processes, and stable institutions. Today, that bedrock seems shaky to many. For example, recent comments about firing the Fed chair or highly fluctuating trade policies have unnerved global investors. One Reuters report found that since late 2024, the dollar slid about 9% against major currencies, largely as the market absorbed non-stop tariff flip-flops and stimulus debates. Investors are beginning to see the dollar not as a guaranteed safe haven, but as one asset among many. A Reuters poll in May 2025 showed a majority of currency strategists predicting further dollar weakness, citing worries over U.S. fiscal direction and global growth slowing. Analyst Steve Englander from Standard Chartered even described the situation as like a betrayal of confidence from a friend, illustrating how shaken trust can turn safe haven demand into a liability. In short, the notion that every crisis automatically sends money into dollars is no longer a sure thing. This sentiment shift is also visible in markets. Earlier in 2025, a U.S. tariff-induced market rout hit both Treasury bonds and the dollar simultaneously, a rare event. Normally, one would rise if the other falls. As Reuters notes, that historic sell-off, driven by fears over reciprocal tariffs, saw the dollar slide sharply against the euro, yen, and others. It even sent the major dollar index, DXY, below 100 for the first time in nearly 2 years. Analysts warn that if foreign investors start hedging or offloading U.S. assets to protect themselves, in effect selling dollars, it could exacerbate the decline. The key takeaway is that psychological factors and policy credibility matter greatly for currency value. When confidence in U.S. policy or leadership wavers, the dollar is vulnerable. In summary, the recent dollar slide reflects a convergence of fundamental and cyclical forces. High U.S. rates have lost steam just as the economy cools, making the dollar's yield advantage less sustainable. At the same time, large fiscal and trade deficits mean more dollars circulating abroad, weakening its price. Meanwhile, global investors are growing wary of U.S. policy risk, unsettling the once unquestioned safe haven status of the greenback. Importantly, many analysts view this period as a reset rather than a collapse. As J.P. Morgan observes, the dollar is currently about 2 standard deviations above its long-run average, which implies more room to fall or revert to the mean. History shows the dollar alternates between strength and weakness, so a downturn is likely at some point, even if the timing is uncertain. For investors, the message is clear: diversify and watch the big indicators. If U.S. inflation continues to ease and the Fed begins cutting rates, or if other economies start growing faster, those trends will reinforce the dollar slide. Conversely, any renewed geopolitical or financial crisis could still temporarily revive dollar demand, but trust and fundamentals seem to be tipping toward weakness for now. As thus Finance Academy's analysis shows, the dollar's recent fall is multifaceted. It's not just one policy or headline. It's the combined effect of a cycle peak in rates, persistent imbalances, and eroding confidence. The dollar may find a floor eventually, but many experts now view its path as downward broadly over the next year. Savvy investors will keep a close eye on Fed communications, U.S. fiscal policy, and global growth trends, because those factors will tell us whether the dollar's crash is a temporary blip or part of a longer trend.